I do think that we're going to have a broader housing correction, and beyond Sydney and Melbourne, for the simple reason that home prices have just gotten away from borrowing capacity. So Shane Oliver published this fantastic chart this week, and that's the chart on the top left. And he's basically tracked the median home price in Australia, based, I think, on totality, etc., against the borrowing capacity. So how much you can borrow with a 20% deposit, average full-time earnings, and mortgage repayments at 28% of income. And you can see that pretty much for the last, up until the pandemic period, home prices tracked borrowing capacity reasonably well. Like they sort of broke away a little bit, but they tracked it pretty well. So as interest rates were cut over, decades really, or since the GFC, basically, interest rates were cut. Home values just kept rising, etc. And borrowing capacity increased because of lending rules and all that sort of thing earlier than that. But since the pandemic, it's completely decoupled. So you can see that, and it's decoupled because because interest rates fell to a trough of, well, the cash rate fell to a trough of 0.1%, and the mortgage rate for owner occupiers hit a bottom of 2.4% during the pandemic. And then after that, the RBA hiked rates obviously to 4.1% cash rate, and that took the average discount for a mortgage rate to 6.25%. So that obviously reduced borrowing capacity by about 30% or so, but prices kept going up, right? So they fell for a little while, but then they kept going up. And now we're in this situation. You can see that borrowing capacity line in blue that Shane Oliver's done is actually turned lower again, and that's reflecting the. I don't know if you did this as of February or if you did this as of March, but obviously we've had two rate hikes from the RBA back to back, and that's why that borrowing capacity is heading lower again. And the interesting thing here is prices at a national level have continued to rise, and the RBA, the financial markets tip another three interest rate hikes this year. So that'd be another 0.75% to the cash rate, so that if that happens, it'll finish the year at 4.85%. That's an 18-year high, and it means that the average discount variable mortgage rate will go to 6.75%, from its current level of what is it? I think it's 6.6%. I think it is at the moment. Yeah, of course, 6%. And I've done the impact of that on the chart on the top right, and that's basically the average discount variable mortgage rate for owner occupiers, and the dashed line is where we are now. And you can see that it's going to keep rising if we get these forecast cash rate rises that the financial markets are projecting. And the mortgage rate from a bottom of 2.4% is going to rocket up to 6.75% if we get these rate hikes. Now, so again, that blue borrowing capacity line is just going to get even further away from affordability. And the impact of those mortgage rate increases are shown in the table at the bottom. So when the cash rate bottomed out at 0.1%, if you had an average size mortgage, so average as of December quarter last year, so I've just used that as the baseline, you would have paid monthly mortgage repayments of 2,870. But if we get three more rate hikes this year, that will have jumped up to $4,774, which is an extraordinary increase. That's $1,900 a week extra in mortgage repayments on the same size loan versus what it would have been when the cash rate was 0.1%. So if it goes from 0.1% to 4.85%, which is what's forecast, the jump in mortgage repayments per month would have been $1,900 a month. So that's obviously assuming the mortgage, the borrowing amount's the same, right? So I just picked out the average loan size as of the December quarter. So this to me tells you that values don't make sense in Australia. And eventually those two lines of borrowing capacity and the red line of home prices, they have to come back together. Like not necessarily fully back together, but they have to converge again at some point. And the only way they can really converge, if we're going to keep having, is either interest rates get slashed back to historical lows again, so that blue line goes back up, borrowing capacity goes up towards the red line, or the red line has to fall towards the blue line, which means falling prices. So I think, we are in for a sizable housing correction. Who knows? Late this year, I'm not sure. I can never pick these things, but based on logic, or based on the data and simple logic of borrowing capacity, they have to converge. And just one last thing on this, I'll just stop sharing because it's always nice to see both of us. Part of the reason why we've had this divergence in borrowing capacity is because of factors such as the 5% deposit scheme for first home buyers. So if you do that, you overcome those borrowing capacity constraints. The Bank of Mum and Dad. The Bank of Mum and Dad is now the fifth biggest lender in the country. The forecasts, the estimates are it's somewhere between $45 billion to $90 billion a year is lent through parents to children, through the Bank of Mum and Dad. When that happens, children avoid that borrowing capacity constraint, right? Because if they didn't have that, they'd only be able to borrow X, but with that, they can borrow far more because the parents are giving them all this cash. Also, we've had a bigger share of investors in the market. So the investor mortgage share in the past several years has increased quite substantially. And investors aren't subject to the same borrowing capacity constraints as owner occupier who doesn't already have a home or a first home buyer, etc. Right? So because they've got existing equity in their houses, in their owner occupied home, which they can leverage on, etc. So there are reasons why the borrowing capacity has decoupled, but eventually those two lines have to converge, at least to some degree, and they can only converge through big cuts in interest rates, which I can't see coming in the near term. Although, as I said last week, I think the RBA will be forced to cut quite heavily once unemployment starts rising, similar to what happened to the GFC. I won't go into that again. If you want to hear more on that, listen to last week's show. But shameless plug. But also the other way is for prices to fall, and we might end up getting both those things. But I just think home prices across nationally at the current level are unsustainable, especially given that we're in a rising interest rate environment. We've got this global energy shock whereby household disposable incomes are going to shrink and real incomes after inflation are going to go backwards. That's very clear. And we're likely to get rising unemployment as well as this
Yeah.
energy shock builds. And then obviously I talked about last week, we're going to have the AI rollout's going to eliminate some jobs, etc. So there's going to be a lot of disruption in the next few years. And I think that's why these really frothy housing valuations aren't sustainable.
Yeah, let yet another cheery episode
Well,
of the macro of the mortgage. Yeah, because
well,
but
it is cheery for some people. Like, if you're in the market and you're looking to buy, this will be music to your ears, right? But yeah, so there's always two sides to the coin.
yeah, for sure. I mean, we did discuss this quite a bit last week. Gosh, we got a lot of feedback and kickback in the comments from last week. Going through it was quite funny, sort of reading through those comments. You never quite know how these episodes are going to come across and when you're going to get the engagement. So, but yeah, it was great to sort of have so much feedback. But in that last episode, I went on a little bit of a thesis about what I write about, which is economic cycles and forecasting market cycles. So it's a little bit left of field for some people to listen to. They don't like to believe that you can forecast the future or forecast when the economic downturns are going to come. But I can tell you absolutely can, and there's people that have made a fair amount of money from doing so. But your timing based on the fundamentals is very close to the timing that I've had pinned for a downturn for quite some time now. I've been saying that 2026 was going to be the peak for this market, and then we would go into a downturn, and by 2028 we'd be into a recession. So at the moment, the timing is lining up for that. 2028, we should be sort of well into the recessionary period because I imagine that we're going to get to that panic point prior to that. The stock market's going to go, the real estate market will peak, the stock market will peak, and then we'll start to see unemployment rise for all of the reasons that you've said. But we also know from that data that the finance data is a leading indicator always of where property prices are going to go. And I agree with you that the only reason that they're holding up to the extent that they are at the moment is based on the government's 5% deposit scheme. I deal in the market every day with buyers and sellers. And in the areas where I'm looking, and this is based in Melbourne, where I'm situated, where they are the more affordable markets, those markets are still going strong and the properties aren't staying on the market for very long. There's no flood of supply. But if you move to the more pricier suburbs where the median is pushing well over 1 million, then those are the areas where we're starting to see the stall now come in and the clearance rates are dropping, which is a great leading indicator as well. So in my opinion, we're pretty much there. Those states that are smaller by population, I would have thought that the gains have been priced in and we haven't got much longer to go. It's a bit of a dismal story, but